The global economy that stands on the brink of a profound transformation, far beyond ordinary fluctuations. The income gap has reached the deepest levels ever recorded in human history, while the burden of debt has turned into an invisible shackle, binding both nations and individuals. As the purchasing power of money steadily erodes, confidence in the financial system is collapsing at its very core. On one side are central banks armed with unlimited money printing authority. On the other, societies that bear the inflationary weight of these policies. Throughout history, from Rome's debased denarius to the Ottoman Empire's foreign debt trap to Britain's abandonment of the gold standard, every great civilization has been shaken by the unraveling of its monetary system. Economic movements are like the tides of the ocean. Every surge is followed by a retreat, every rise by an inevitable fall. Today, the global economy is advancing toward perhaps the most turbulent phase of this eternal cycle. The denarius, once a symbol of the Roman Empire's might, gradually lost its purchasing power as the silver content was systematically reduced under political and fiscal pressure, a financial decay that hastened the empire's collapse. The Ottoman Empire, too, was driven to fiscal bankruptcy through foreign borrowing and uncontrolled paper money issuance. Even Britain, after World War I, was forced to abandon the gold standard. In all these historical cases, the erosion of monetary credibility led to mass impoverishment, and ultimately a transfer of power. The difference today is merely in form. Money is no longer a tangible object, but a digital entry. Yet the essence of the system remains unchanged, a mechanism built upon debt. In the modern financial world, debt has evolved beyond an economic tool into a global instrument of control and influence. The most sophisticated instrument of dependency in the modern age operates through the debt system. Individuals are bound by invisible yet unbreakable chains: mortgages, auto loans, student debt, consumer credit. The promise of a better life turns into a lifelong repayment cycle. Governments, corporations, and individuals are all indebted to one another, with central banks sitting at the top of this intricate hierarchy. The creation of new money inevitably means the creation of more debt. Every new dollar, euro, or lira enters circulation as the counterpart of another debt. Thus, a money system independent of debt is almost inconceivable. No matter how hard one works, the result is not financial freedom, but a deeper cycle of dependency. The most sophisticated model of economic servitude the 21st century has produced. Economic crises are not times of fear for capital holders, but moments of strategic opportunity. The inherent volatility of economies ensures that every boom is followed by a correction. Those who can read this cycle anticipate market panic with patience. Warren Buffett's multi-billion-dollar cash reserves stand as concrete proof of this liquidity waiting for opportunity strategy. Buying high-quality assets at rock-bottom prices during crises is the core mechanism of wealth transfer. The Great Depression of 1929, the bursting of the dot-com bubble in 2000, and the global financial crisis of 2008 have proven this pattern time and again. While the masses sold in panic, the calm and prepared investors bought. The real divide lies between those who succumb to fear and those who turn it into strategy. The coming economic wave will ruthlessly eliminate assets that do not generate real value. Companies with strong production capacity, low debt, and high dividend yield will survive. Those relying solely on speculative value and brand prestige will fade. The post-2008 rise of tech giants like Apple and Amazon was no coincidence. A similar divergence will appear in the years ahead, even sharper and clearer. Precious metals like gold and silver, fertile agricultural land, energy resources and water rights, tangible and finite assets, will preserve their value, while speculative real estate and overvalued digital assets will lose it rapidly. Gold is not primarily a tool for accumulating wealth, but for preserving it. During crises, the key is not achieving high profit, but protecting existing savings from inflation and market erosion. In times of economic turmoil, the most valuable capital is not knowledge, but composure and calmness. Most investors act instinctively and emotionally, greedy during booms, fearful during crashes. Yet every successful investor throughout history has demonstrated the discipline to move against the crowd. They retreat during times of euphoria and optimism, and act decisively when panic and fear dominate. The greatest fortunes in history have been built when the streets ran red with fear. Financial media only amplifies these emotional waves. Limitless optimism during the rise, catastrophic scenarios during the fall. Yet the economy by nature is cyclical. Those who can read this cycle, not emotionally, but analytically and historically, always gain the upper hand. Every economic crisis marks the birth of a new and often more resilient order. Transformation is inevitable. What matters is where one positions oneself in it. The technology sector will continue to be the backbone of the new era. Investments in artificial intelligence, industrial automation, energy efficiency, and cybersecurity will keep expanding. Energy independence will become a matter of national security. Solar, wind, and battery storage technologies will shift from luxuries to strategic necessities. Food and water security will climb the global priority ladder, making agricultural technologies and resource management among the most stable investment fields. True and lasting wealth will materialize in fertile soil, clean water resources, and real production capacity. Alongside this, the most valuable capital will be the individual, one's own skills and adaptability, the ability to adjust to change, learn rapidly, and solve problems creatively. Diplomas will lose value compared to these competencies. As health systems evolve, efficient and accessible private solutions will rise. Ultimately, community bonds and mutual trust will become the most enduring pillars during times of crisis. Real wealth will not be measured in gold reserves, but in the strength of networks of solidarity among people. Great economic collapses transform not only markets and corporations, but also political regimes and social contracts. Governments, invoking states of emergency, may resort to wealth taxes, capital controls, and strategic nationalizations. Societies gripped by fear and uncertainty easily accept such radical measures. Therefore, those seeking to preserve their wealth must remain vigilant and prepared, not only financially, but also politically and legally. Timing is everything. Acting too early can be costly, but acting too late can be devastating. Preparation must be gradual and disciplined, starting with cash security and liquidity, followed by shifts toward real and fundamental assets, and finally, the readiness to act decisively when opportunity arises. The math is simple, but ruthless. An asset that loses half its value must double in price to return to its previous level. Those who can buy near the bottom reap the highest returns during recovery. Investors who followed this discipline during the 2008 crisis multiplied their wealth in the following decade. The post-2026 period may represent a similar turning point and a historic opportunity. This time the winners will not only be those with vast capital, but individuals with knowledge, intuition, discipline, and above all, composure. History never repeats itself exactly in form or detail, but its rhythm and structure always rhyme. The Great Depression of 1929, the inflation crisis of the 1970s, the dot-com crash of 2000, the mortgage crisis of 2008. Now, a new stage, a new act, begins. While the majority keeps dancing to old tunes without even hearing the new rhythm, a prepared minority has already sensed the shift, and quietly completed their preparation. When the dust finally settles, only one sentence will remain true. The greatest fortunes of the 21st century were built by those who, in the turmoil of the 2020s, never lost their calm or foresight.